Hello, welcome. We are on acquire and operate. Heady topic today. For context, those that are just joining us, we are acquiring and operating and working towards a $15 million EBITDA portfolio of micro SaaS firms. We're doing it with a super lean operating model, a few humans that punch above their weight class, and we are kind of growth oriented. Most of our skill set and background is in go to market. We got Kale here holding it down. I'm joined with the one and only K Lou. How we doing, buddy?
I'm doing amazing. Excited to jump into this episode. It's a lot more technical and in the financial weeds than last episode, but lots of tidbits and learning lessons for the audience.
Yes, this is a heady one. So, and as noted, right, like I guess we try to maintain general content beats. So up until this point, we were, I would say probably a quarter of our time was on origination, kind of keeping half of one eyeball there, analyzing deals, our scorecards and frameworks, and then we'd share out the stuff on the deals that we passed on and why. And then like the rest was operating, frankly. So it was OKR, teardowns, operating concepts, and then musings. As we shift gears and start to think about acquisition too, you're going to see our content reflect that. So what does that mean? More acquisition concepts. So how do we value deals? Way more in the weeds around diligence tactics, stuff like that. So for today, we're going to talk about the number one factor to determine maximum valuation in micro SaaS. And I guess as a headline, right? I mean, like valuations are a very intimidating topic, period, for any human under the sun. It's like, well, I didn't get my MBA. I don't know how to do discounted cash flows, et cetera. And the thing is kind of an intimidating topic by design. Like the world doesn't want the common human to understand how to value businesses because that's kind of an edge for the elite. So the hope today is to kind of deconstruct the mythology around valuations and most importantly to put it in the context of micro SaaS, where in privates period, so private equity and venture capital, private markets where there isn't access to public data, it's very challenging, right? Because you're like, hey, and we'll get into this, but it's like, I guess imagine trying to value a house if you had no idea what all the houses around you were trading at. And you're like, ooh, I don't know what that house sold for. I don't know if it had 2 or 3 rooms. I'm not sure if it had a backyard or an indoor garage, right? You're just kind of flying blind, right? And so thankfully, and I guess another caveat too is micro SaaS has pretty unconventional deal structures. So there's sellers notes, there's earnouts, there's all kinds of wonkiness. So if you're a SaaS founder or an acquisition entrepreneur, it's like, okay, I've got no data working for me. I'm not a super competent financial modeler. You just kind of scratch your head and go, I don't know, maybe I give up. So the hope today is, again, the context is micro SaaS. So think SaaS companies that are doing 250K to 1.5 million in ARR. And instead of hitting you with a really buzzy kind of valuation calculator, which is what most humans like us do, where it's like, enter this, and then here are the premiums for growth rates, and this is based on this other stuff, which all ultimately was derived from public markets, which is so far away from what we do. We wanted to talk about the number one thing that influences micro SaaS acquisitions, and that is debt financing. So we'll go into that. But I think the piece here, or something that I learned long ago, which was very interesting, it's a book called by Walker Diebel. It's called Buy and Build. And another one is How to Buy a Small Business. It's kind of a classic from HBR. But there's this saying, right, that is, can the business afford itself? For somebody that's looking to buy the business. And it's like, okay, well, what does that mean? It means if I need to take out a loan of this size because the seller wants that valuation, is the income enough from the business to pay off the debt for the loan size? So simply put, this valuation is here. I'm going to need this much debt to achieve that valuation and finance the deal. My debt payments are going to be this. Does the business prove that it can service and pay off those debts with the existing cash flow? Because if I'm a lender, it's like, we're not going to lend to you unless you can guarantee that you can pay off your debt as a function of the productivity of the business that you're going to buy. And that gets even more interesting for the common lender in software because there are no assets, right? There's nothing. If the business is insolvent and you liquidate everything, it's like, yo, here are our laptops.
Here's the domain.
Here's our list. Like, we have no assets. And so this becomes even more important because the average buyer in our context is very likely using an SBA debt. An SBA loan, rather, a 7A loan. And these loans come with specific criteria. So when we go into, so before we kind of jump in this, and we'll kind of wrap, because the hope here is providing a calculator. So it's like, oh my God, what's my business worth? It's like, cool, enter in your ARR, enter in your operating profit or your EBITDA, and then enter in a multiple, and you'll kind of see, okay, at this multiple, my valuation is X. Does my business generate enough cash to pay off the debt that some buyer would use to acquire the business? So hopefully the calculator is kind of a starting point for like, okay, what is my business worth now? If we assume it's a kind of your conventional micro SaaS buyer, and that's kind of a baseline for you. Obviously, you want to take advantage of all the resources available to you, and we'll get into that. But like one example is acquire.com. Like marketplaces have good benchmarks, right? Because they have visibility into all these transactions. The got you there is that sometimes those benchmarks are based on asking price. So that's like basically like, hey, what's the average price that all the houses around us wanted to sell for? Which is very different than what did they sell for. So just be careful. They have way less data around actual transaction history, and it's much more around asking price, which is a made up number. So just don't fall for that. So real quick, I'll share my screen and we'll kind of jump into it. Let's see. Here we go. Cool. So here's the calculator just to give you the quick scoop on that. So we have, as I mentioned, and we can actually well, you can poke around with it. I don't want to bounce around screens too much, but blue indicates the inputs. So here we've got ARR. I use the example of 750K. The operating profit is 200K, which is a very solid profit margin. And we started with, all right, let's ask for 1.5x ARR. And we're going to talk about why using an ARR multiple is a terrible idea in micro SaaS and why you see it a lot. But we're going to say, okay, let's use 1.5. But I guess in this case, it's useful because ARR is a way easier number to kind of benchmark peers against because it's standardized. If you roll up all the subscription revenue, it's one number. Cool. I can understand the size and the scale of these different businesses. When you start to look at operating profit, EBITDA, net income, there's a ton of variance. And you're like, oh my God, I was actually looking at a $20 million business that's not profitable at all. And it has the same profit margin as a 200K business, right? So the comparables start to get really wonky. So ARR does have its uses. So here we entered in a 1.5 multiple, and then there's a little bit around the deal structure. So you're probably going to assume that in any scenario, that especially this debt finance, the bank wants to see a seller's note to kind of keep the seller in the game. So it would be 70% seller's note. 70% SBA loan, 10% seller's note, 20% investor equity or cash. And then you can modify the debt terms here however you see fit. And then the debt service coverage ratio, which is what we'll talk about here, but basically the SBA wants to see $1.25 of income for every dollar of debt. Makes sense? So you basically need an additional 25% to cover the debt payments for the bank to be like, okay, cool. Like we're pretty confident that the business can afford to pay off this debt, regardless of the competence of the operator or whoever's acquiring it. You could, like my recommendation, never adjust this down because 1.25 is the floor. You may want to adjust it up to 1.5 because that's probably a little more conventional because SaaS, again, banks are like, well, if shit hits the fan, we've got no recourse. And with SBAs, you have to sign personal guarantees and stuff like that. So they can come after you personally and seize your house and do that other stuff. And that speaks a little bit to the risk profile in our world. Anyway, at 1.25, it's like, okay, so if I want to ask for 1.5x my 750K ARR, that's a business value of 1.125 million. In terms of the total debt, so we've got the SBA loan and the seller's note. That's about 177K per year. So this business needs to generate 169 and change in operating profit or EBITDA, or it needs to run at a 22% margin to qualify for a loan like this. And it's like, oh, great. Like we're generating 200K in operating profit. That's a debt service coverage ratio of more than 1.25. Happy days. And this little thing will update yes for you. But as you see, when you start to creep up the valuation, it's like, all right, well, let's look at a multiple of 1.75. Let's look at a multiple of 2. Let's look at a multiple. Eventually, it breaks. And then you're like, okay, this is the ceiling for valuation then, based on a debt finance kind of buyer, which is the most common in micro SaaS. Let me pause there. Kaylu, death by numbers and getting peppered with all kinds of weirdness. Did that follow? That makes sense? Any feedback?
So I'm gonna say that followed for me since I was here the entire time with you. But yeah, it was purely clear, especially the way that you went down row by row. No additional questions. I think for a lot of folks that are listening, once they can get their hands on the calculator, it'll start to make a lot more sense. This is not the kind of topic you just listen to and say, okay, I got it. No, you have to get in there, plug your numbers in, and see what it evaluates out for you.
Yeah, and I think the point is that this is based on real world conditions, real
Yes.
world constraints, right? I think so much in investing is perceived value, right? And that's, what's it cost? I don't know. What's it worth to you? right? So we want to try to establish something that is grounded in reality, because outside of that, it's like, well, I saw these benchmarks from this marketplace, or I did this weird DCF. I paid some MBA intern to do it. I'm not really sure if it's accurate. This is like, okay, I know that this is probably the upper bound, the upper limit, the upper constraint for what the business value could be. Cool. So hopefully that helps. This would have been very helpful for me if I was a SaaS founder once upon a time. And
Yeah,
then
I was gonna say, well said, because you look at most other publications, they kind of give you some of the information, but not real world examples, like you said, plus calculators and takeaways that you can actually use. So this is already taking it a level ahead, and I mean, this is just brilliant.
cool. So let's I'll kill the old screen share there. So now let's go into, okay, so it's like, got it. So I could flip around and be like, oh my God, what multiple should I use? Oh my God, I need to model out discounted cash flow. It's like, cool. Use the calculator, start there. Great. I know that my business that's doing 750K in ARR and that has a 200K operating profit or EBITDA margin is probably around a 1.5x multiple to feel comfortable, because that means that somebody who's using debt can buy the business, right? You could flex it up just a little bit, like maybe to a 1.6, 1.7. I should have put it at the very threshold, but you're good at 1.5. I can say that. So now let's shift gears and talk about conventional valuation methods. And my hope here is to remove as much complexity and kind of debunk these by using metaphors. So a multiples based valuation is a lot like saying, okay, let's think about real estate appraisals. So it's like, okay, let's look at so we know that our house has 3 bedrooms, 2 bathrooms, a garage, blah, blah, blah. We know that houses like that in our neighborhood are trading for $1 million. Then you could say, okay, let's come up with some multiple. Let's just use bedrooms. We have 3 bedrooms that traded for $1 million. That, and then what would that even be? That'd be like 300x multiple or something. But it's like, okay, cool. So we know that when we're looking at houses, we should take the number of bedrooms in the house in our neighborhood and multiply it by this value, or by this multiple, which in this case would be number of bedrooms, and we'll come to a value. Great. So it's basically a shorthand way to do it, where you look at the dollar value of a thing and you find a metric that you can associate with that dollar value. And then that metric informs a multiple that you can use to apply to other assets. How was that, Kev?
Makes sense. I might have gone the square footage route.
Yeah, there you go. Yes. Well done. So in private business and SaaS in particular, it's usually ARR or EBITDA, or trailing 12-month profit. So in those cases, let's take a scenario. So we have a SaaS company that's generating $1 million in annual revenue, recurring revenue. We know that company, and the most typical comparable here is a function of market size, profitability, and growth. So it's like, hey, this is in the $1 million tranche. We think that reflects some level of stability as a function of scale. We know other companies like that. And then you might think about growth. You might think about some other factors, but eventually you'll kind of land on a multiple. It's like, okay, cool. A SaaS company generating $1 million in annual recurring revenue. We know that comparable companies have an average ARR multiple of 2.5x. 1 million times 2.5x. It's a $2.5 million business. So this is, and I need to clean this up a little bit, but the headline here is don't use ARR multiples.
It doesn't tell the full story.
Like, don't use ARR multiples. The reason that they exist is because they're a convention from publics and from venture capital investing, where again, ARR is a much easier kind of consistent metric to benchmark different companies around. As I told you, when you start to get into EBITDA, there's such a disconnect, or there can be such a disconnect from EBITDA to ARR, especially for high growth SaaS companies that are intentionally spending as much money as humanly possible to acquire. Like, none of them are profitable. They're trying to, and the whole promise to investors is we're going to grow the shit out of ARR as fast as we can, and then we're going to strip out all the costs, and we're going to collect the cash flows from these recurring revenues. So we're going to spend now to harvest returns in the future. So again, nobody should measure EBITDA because it would all be zero in that context, right? Like, all these companies don't run at a profit. But everybody in Publix, everybody else in the world uses ARR multiples, and that's kind of what informs the comparable. For us in Micro SaaS, like, we're trying to acquire an enduringly profitable business, grow it modestly to some place, and then live off the income or generate a return for our investors. So ARR, it basically sets the ceiling for how profitable a business can be. And that's his only use in our context. You never want to use multiples because you're not paying for ARR and crazy growth and all this other stuff. You're paying for a business's ability to generate profit. Anything you'd add there, Kev?
Yeah, I would say some real life examples of the ones that are operating off of that ARR multiple that are not profitable would be big behemoths like the Lyfts and the Ubers of the world, the Facebooks. They have the buying power within their domain, but when you actually look at their balance sheet, yeah, you have the users, but profit wise, no. And that's not, we're trying to play the opposite game in Micro SaaS. We're looking for those that do have that operating profit that we could apply the multiple to.
Yep. So don't use ARR in small, mid-sized business acquisition, in circuit acquisition. Don't use ARR multiples at all because it's oranges and apples, right? Like ARR is only useful because again, it sets kind of the ceiling for how profitable a business can be. We're trying to get to $1 million and then put our elbows out and hold it and hold that space because we're not getting competition from venture-backed players that are like, we'll spend $1 million to acquire a customer. We don't care. We need to grow at all costs. And you're like, yeah, you can't compete with somebody that's irrational. So anyway, I'll leave it at that. So just to kind of put a button on it, multiples are very challenging in Micro SaaS, A, because they are totally misleading and you should never use them. B, there's almost no publicly available data. C, multiples are, especially in SaaS, and you can just look at kind of the course correction. A lot of this was a function of, the ZERP era and zero interest rates. But multiples are based on the future prospects for the most part of a business. If somebody's super bullish on the growth prospects of a category, of an industry, of a specific company, they'll pay a premium because they're like, ooh, they're going to grow ARR. ARR is going to get super interesting. We're going to rip out all the costs and we're just going to collect cash until we die. But if that market sentiment shifts, it's like, hey, the thing was going to be a 10x and now it's a 4x because the market thinks this industry sucks. Obviously, you can't control that. So be very careful around market sentiment. And then obviously growth, it's a function of growth too. So, there's scenarios where you start a fundraising process or you start to explore a transaction, an exit, if you will, and you're growing at 20% at the start of the year, or you're growing at 40% at the start of the year. You start talking to financial buyers, they're super jagged, financial investors. Oh my God, we're going to pay you a 10x ARR. The back half of the year, you're like, oh God, we had a crappy few quarters. Now we're growing at 10%. And they're like, yeah, that 12x is now an 8x. And you're like, so anyway.
And seasonality is a thing. So
yeah. There's just a lot of factors you can't control that are going to come after you. Okay. Multiples. What are we there? Okay, let's move on to discounted cash flow models. I got another metaphor for you, Kev. Okay, so think of discounted cash flows as valuing a tree by predicting how much fruit it'll generate and how much fruit you can harvest over the next 5 years.
So like a farmer literally valuing how much he can harvest next season and then putting a number on that today.
So it's like this tree will create $100 worth of fruit in the next 5 years per year. So $100 in year one, $100 in year two, $100 in year three, $100 in year four, $100 in year five. Well, we know that there's a kind of a time value to money, right? If I have $100 today, it's worth less tomorrow because of inflation, but also because I could have invested that $100 and generated a return. So money tomorrow is not worth as much as money today because you can do something with money today. So we say, okay, this tree is going to generate $100 next year, each year after. What would that money be worth today? And then that's and then you discount. It's called discounting it back to the net present value, to today's value. And then you're like, okay, that tree is worth whatever it is, right? Which and so some things in terms of how you calculate discounted cash flow, there are three main components. One, the future cash flows that we just talked about, and that's basically like, hey, this business is generating $100K in profit today. It's stable growth, 5 to 10% growth. I'm confident that we can sustain that level of growth. I'm confident that we can, operate that business with the same cost model. You build convictions around the future cash flows and you model that out. So this again requires modeling, right? Like, okay, we're going to need to scale up support. We're going to need to do this other stuff. Cool. So what does that do to the profit? It's like, well, actually, it's probably going to be closer to $80 a year for the next 4 or 5 years. Okay, whatever it is. You kind of get to that place and then you apply a discount rate where it's like, okay, this thing's going to generate that much cash. We discount that back to today. But now I need to think about like, what's the risk for what's the minimum return I need to generate? Well, I probably if I had put the money that we're going to use to buy this tree, if I'd put that into public markets, if I had bought real estate, I could have generated a 10% return. and this is extra risky. And so that's, another 5%. So we're going to say that the discount rate, or this, the weather might happen, the trees, are surrounded by bugs that might eat it, whatever.
Cicadas.
Right. Yeah. Like weird shit that I don't know. And it's like, and that's like that's worth 5% return to me. And it's like, okay, cool. So the discount rate is $15. Or 15%. You apply that discount rate to the future cash flows. And then you say at the very end, the tree has a terminal value. And we're like, oof. And in software, you have to be very careful because it's almost impossible to predict the terminal value of a business 5 years from now, especially given the rate of change in technology, right? So, I mean, I'm kind of the camp where it's like, there is no terminal value. After 5 years, who the hell knows, So,
right. Or like you have 1 year for your terminal value.
Yeah. Or it's like, I guess it's worth $1 million, or this tree that generates, it's worth $100 at the end. All right. So it's like, cool. So we've got our discount rate, our future cash flows, and then the terminal value of the thing, which means it's like last leg. And then you add those things together and you get a return. So unfortunately, this is way more technical than multiples. This requires modeling, but don't be intimidated. Like the model is basically just to get confident about what the future cash flows of the business look like based on growth and based on cost and how costs scale with growth, stuff like that. And then it's a pretty simple calculation in Excel or Google Sheets. It's NPV. And a lot of times you want to also consider working capital and capital expenditures, but those aren't quite as relevant in SaaS. Obviously, you need to capitalize a lot of software investments, but it's not the case where you're buying out cash to buy equipment and you're like, oh, actually, every 2 years we need to refresh our factory and that costs all the money. And it's like, oh shit, there are no cash flows. The tree, we gotta totally paint the tree a new color every year. It's like, oh, that costs money and that's gonna just wipe out whatever we would have gained.
Exactly.
So anyway, here's an example. So we've got a SaaS company that's projected annual free cash flows, which in our case is basically just operating profit. But the thing that would, like, to really get the cash flows, you need to think about working capital, which is like this cash balance that you need to maintain to fuel. Typically, it's like inventory and stuff like that. And then a terminal value at the end. And we all just kind of agreed that it's not a factory. It's a SaaS company. It's all intangible. But it's going to project this SaaS business is going to generate 1 million in free cash flow for the next 5 years. And we're going to give it a 10% discount rate. We probably should have given it like a 15 to 20% discount rate. And then if you do all that and we say that at the end, it's going to be worth $5 million, you discount all that stuff back, that business has a value today of 6.9 million. Cool.
Yeah, so a little bit of compounding effect happening there. And I would say, put another way, yesterday's price is not today's price, and the discounted cash flow model is a great way to derive at what that value should be.
And it's a way easier, like, I guess, negotiating on multiples is a fool's errand. It's like, well, I think it's worth a 3x. And it's like, yeah, well, this company's growing at 20, like we're growing faster than them, but we're less profitable. So we think it's a 3x. It's like, well, actually, we care more about profitability than growth. So you're worth less. And I don't know. It's just, you kind of run around and around in a circle. If you're thinking about discounted cash flow, you can be much more prescriptive with what you're debating. So it's like, help me build confidence that we can continue to grow this business at 10%. Help me build confidence that we're not going to incur new costs, that we can preserve as much as possible the current profit margin into the future. Well, let's talk about the cost structure. Let's talk about the support burden. Let's talk about how many humans it takes to manage that support burden. It's just a much more constructive and productive conversation where you can, again, be pinpointed with what you're debating. And those debates, by the way, are also super enlightening if you're diligencing the business, because then you're like, okay, our thesis really comes down to de-risking these 2 or 3 things. Right. And then that informs everything that you do.
And then this level of due diligence actually informs the buyer on the quality of the founder, the quality of the business itself, like how diligent were they in scaling the company, and will I walk into any trap doors because this person cannot answer all of the questions that I'm asking? You know what I'm saying? So the more someone can have that full conversation with you around a discounted cash flow model, then you're probably walking into a much better quality situation.
Yeah. Or the other red flag is it's only one person answering.
Yes.
And it's like, oh shit, key employee
You're
risk.
in charge of all of this?
Key employee risk. It's like, wow, oh my God. Okay. Right. So yeah. It's a productive exercise. So again, if you're in the trenches, arguing valuation, it's way more pointed to be like, all right, how can we sustain the growth? Right. Then they'll tell you, well, this is what we've done. This is how we would continue to do it. This is what's been most effective. Tell me about your operating model. Like, when did you decide you needed to hire somebody for this? How did you decide what you want to pay them? What do they do? What are their KPIs? It's just way more productive. Cool. So I did want to cap just to bring things together. So we had used some terminology throughout this. At the end of the post, there's just kind of a recap to really kind of unpack the SBA stuff. So what you need to know about an SBA loan, and I won't go too far into it, just think of it as a loan that is it's a government sponsored loan for the most part, which means the government says we're on the hook for a percentage of this loan so that lenders are more likely to lend, right? So, and it's been a huge growth catalyst for the franchise industry, for all kinds of places, because banks are probably more, especially in SaaS, they're like, we're not going to lend on that. Like it's a hot air balloon. If it pops, there's nothing in it. So we could go into kind of what the SBA is, but let's just treat it as like a business loan that is the most, I guess, prominent in our sector. So there's terminology called DSCR, which is a debt service coverage ratio. And that ratio sounds intimidating, right? Death by more acronyms, but simply put, the bank wants to see $1.25 of business income for every dollar of debt, and of debt payments, right? And the debt payments are a function of how big the loan is. So if you have a big valuation, big loan, big debt payments, and eventually the debt payments surpass the income that the business generates, and that's a deal breaker. So that's really it. And you'll read a lot more, and there's certain qualifications for SBA. It's very risk on for whoever takes one on, because you almost always, anybody who owns more than 19% of the business has to sign a personal guarantee, which in SaaS, it's like, if shit goes south, you can come take my house.
Like, and things typically go south.
You can take my house, and then okay, or I don't have a house to take. Cool, you can bankrupt me, and I'll file and I'll take a true L and start over with miserable credit scores. So it's risk on, but it's 10-year terms, and the longer you have to pay off a loan, the lower your payments are. So that's very conductive if you're an operator. And the interest is, I think it's 4 points above prime. So it's the cheapest, longest term debt you'll ever find, which is why everybody uses it. On the downside, you have to sign a personal guarantee. It's typically 90 days to get a loan done, which doesn't lend well when we're competing on speed to get transactions done. But it's what's common. It's what's going to be used. So the more woke you are as an acquisition entrepreneur or as a micro SaaS founder on what the SBA is, how your business meets the qualifications, what kind of the maximum value is that you can command based on the perceived debt service, et cetera, just more eyes wide. And I would start there, whoever you are, start there as kind of a point of departure for valuation.
Well said.
Okay, Lou, damn. Next week, we're getting back to operating, so you can do all the talking, my friend. I'm out of breath.
Let's do it. We'll dive into more cold outbound and our learning lessons.
I love it. All right, my friend. Well, pleasure as always to share the field of battle with you. I will see you next week for the love of the game, eh? Oh, laser beams, baby. Let's get them laser beams. All right, pal. Catch you later. Good stuff.
All right, take care.